In this video, I'm going to talk about 5 things that you should never do while investing in stocks so you can make the most money possible in your investments. The first is not to buy high risk assets with the bulk of your portfolio. This is a common mistake that I've used to make plenty of times. For an example, here's a story about a crypto millionaire who became a millionaire after investing in a specific coin in early 2021. He invested about $188,000 of his life savings in this coin, and he saw his investment grow a lot. I mean, it went to $2 million in about 2 months, and he kept holding as his investment grew and as it dropped, but he didn't sell anything. Now, as of the summer of 2022, that investment that was up to $3 million was worth about $230,000. Now, going from $188,000 to $230,000, I mean, that's a decent return, but imagine the amount of heartache that you will feel knowing that you could have had $3 million. And this is one of the dangers of putting a lot of your money or a lot of your portfolio in these high risk assets like crypto or NFTs or penny stocks or out of the money stock options and things similar, because when you put a lot of money in these type of assets, it starts to have a big impact on your emotions and your decisions, and I'll talk about that later on in the video. It's very easy to be interested in the stock market because you hear stories about people that took a little bit of money and made a lot of money, which it does happen and it can happen, but not for the majority of people. And if you have a small amount of money and you want to turn into a large amount of money really quickly, 9 times out of 10 you're gonna have to make some very questionable and risky decisions. So it ends up becoming more of a gambling thing instead of investing and trading. And the reason why is because it's very difficult to build a consistent and reliable strategy with these type of assets, because these assets in themselves are not very consistent or reliable. Typically, it's taught that when it comes to these type of investments, you want to invest money that you don't mind losing, because you can lose it. So if you have money that you're really counting on as far as the future for your savings or even other goals, do not put them in these type of assets. The next part to this is not to go too heavy on individual stocks. Now, I wouldn't categorize individual stocks as high risk assets, compared to like crypto and things like that, but they can turn into high risk assets if you only go all in on 1 or 2 of these stocks. So maybe 5 years ago, I was trading with some friends and we had a penny stock that we were all invested in, and pretty much all of us were all in on this stock because we just bought into the story that, hey, this stock is going to be the one that actually makes it to these small cap exchanges and get off of the penny stock market. I bought this stock and I kept buying more shares for almost a year to where I didn't have any other money in my account but this penny stock. It sounds kind of crazy to think about it, but I did it. So I'm sure you can kind of see where this is heading. By putting so much money into one stock, you start to grow a skewed view of the company. Since you want the company to succeed so you can make money, you start to discount all the red flags that you may see. So what do I mean by this? I remember seeing a lot of red flags as time went on with this company, and I knew deep down that something wasn't right with the company, and anytime there was some news that came out about the company that didn't really seem positive, I would find a way to justify why I should continue to hold this stock. Just be patient, like many people say. But over time, the red flags and the warnings started to increase and the stock started to fall. But even as the stock was falling, I still found a way to justify why I should buy some more or average down, because I had put all of my focus on this one company. So as the stock started to drop more and more, obviously my investment started to decrease and decrease even more. And I kept holding to the point to where I pretty much lost all my money to this one company, which stops you from being diversified. I could have invested in that company, but if I would have had investments in other companies, it would have negated the losses that I had if I would have been more careful about diversifying my portfolio. And honestly, that was the last time that I bought an individual stock. Ever since that big mistake, I've only been investing in index funds and mutual funds. Now, once you have a good base in your portfolio with some diversified assets, it might not be a bad idea to invest in individual stocks for companies that you just really enjoy, or if you want to start trying to get some dividend income, but I wouldn't start out just by buying individual stocks. I at least want to make sure I'm diversified first before I start doing that. The next one is don't buy and sell based on your emotions. Now, doing this is a lot more difficult than a lot of people realize. All the successful traders that I know and investors that I know, they have like a stone cold heart. They can have the biggest win of their life and it doesn't change their mood much. They can also have the biggest loss of their life and it still doesn't change their mood much. So the main 2 emotions that you need to be concerned about are fear and greed. Fear has multiple forms, and one of them is called FOMO, which is the fear of missing out. So FOMO is you see a stock is moving up and you think that if I don't buy my stock today, it's gonna go to $1 million and I'm gonna miss my opportunity to get rich, which is obviously not the case. Then you have the fear of loss, to where if you're already in a stock and you know it's a good company and you know it's a good investment, but they may have a bad news article or just a bad few months or even a bad year, and you get scared of losing more money and you end up selling your shares. I used to do this a lot. I would be in a stock and I knew it was a good company, I knew I had a good price that I bought into, and the stock would drop for whatever reason, and instead of being firm in my decision and being patient in my decision, I would sell it because I was scared of losing more money. So then what happens? I look 2 or 3 weeks later and the stock has rebounded and most likely went even higher than where I bought it from initially. So I would have actually made more money on it if I just would have held on to it and been patient. Then you have greed. Now greed comes into play when you're in a stock and you're making money, but you don't take any profits. Like we mentioned about the crypto millionaire that we talked about at the beginning of the video. Since you want to keep making more money, you decide to hold on to it as tight as you can and you don't take any profit at all. Because in your mind, you convince yourself that there's no way that this stock doesn't go to $1 million a share. So this battle between these two emotions creates a pretty nasty cycle. You buy a stock, you start to make money on it, but you don't take any profits because you want more. So you hold on to it. Then something happens and the stock starts to drop, but then the fear kicks in and then you get scared of losing more money. So you sell your stock only to look back a few weeks later and the stock has rebounded and went even higher again. So it ends up putting you in a very unstable mindset to make clear decisions on your investments. So be careful about fear and greed when you invest in anything. The next is don't follow trading tips. Following tips and investment groups will ruin your account. Now, if you have close friends that you're investing with and you're trying to learn the stock market together, then that's different. But I'm talking specifically about groups, especially ones that have a premium membership. And I'm going to explain how it works. Whoever runs the group, which it'll be a few leaders of this group, they'll make it to where it seems like their stock tips and their stock ideas are exclusive to everybody and no one else knows about these tips but them. So they'll start to buy the stocks at the price that they want. Then they give the stock tips to their paid members and whoever's next ranking in the group. So then the paid members or the premium members start to buy shares also. So obviously the stock continues to go up. Then the group leaders will give the stock tip to everybody that's not paid or premium, which is the bulk of the group. Now this is where the game comes into play. Since the bulk of the group is not paid or premium, everybody starts buying the stock at the same time. So it creates a really big jump in price and it's a very fast move in price. So what happens while the people that are at the bottom start to buy the shares, the group leaders and the premium members start to sell the shares that they bought at the beginning. So in the end, they're the only ones that make money. The ones that bought the stock at the bottom now need the entire market to come into play just so they can make money, which typically does not happen. So be very careful about stock groups and trading groups. I would say even be careful about the advice that you see on TV shows like on CNBC, because everybody's invested in their own portfolio and everybody wants to make money. So even though Jim Cramer told you to buy a certain stock because he loves it, you still have to be careful, because if he's telling you he loves it, he probably has some shares of that stock and it's in his best interest if the millions of people that are watching his show go buy that stock as well. The next thing is don't be inconsistent. Being consistent will help you to build your account, especially if you're investing in things like index funds, mutual funds, or ETFs. Being consistent will help you to not make emotional decisions. An example of being consistent is you have a set amount of money that you decided that you're going to invest per month. You know exactly what you want to invest into every month and you contribute that money to those investments every single month. No matter if the market is doing very well or doing very bad, you made the decision that this is what you're going to invest into. Now, how does this help you? For one, it helps to remove the emotional decisions from your investments. You know that you're going to buy no matter what, so there's no reason to have fear or to have greed. A perfect example is during the pandemic, the market took a really deep dive and a lot of people were scared and they were selling out of their 401ks and just all around panic. But the people that were continuing to be consistent and buying and investing into the market saw some really big increases and the market started to bounce and rebound even higher and start to hit all-time highs. And in the end, it seemed like the people that made money after the market rebounded after the pandemic, they seemed like they were geniuses, but that wasn't the case. The only thing is that they were consistent and they didn't let their emotions get into the way of them investing into the market. So be consistent as to when you're going to invest into the market and be consistent as to what you're investing in. So that way you can build your account effectively and efficiently over time. So that's what I have for you in this video. If you like the video, please like the video and subscribe to the channel for more content like this.